In today's video, we're going to talk about the recent movements of Lucid and explore the data points that have been driving the stock's movement. We're also going to talk about the need for Lucid to tackle the excessive manipulation and short selling and how it can potentially address the issue. We're also going to take a look at, we're going to talk about, not take a look, sorry. We're going to talk about Lucid's upcoming Q2 earnings and then evaluate the analyst's prediction or the overall sentiment. Now, before we begin, if you like my content, please like, comment, and subscribe to my channel. Take a look at the equipment links in the description below. Any purchase made through those links will yield me a small commission. So thank you in advance for your continued support and presence, and let's begin with today's topic. Lucid stock has experienced a highly volatile ride recently, with significant fluctuations in price. During the latest trading sessions, the stock closed around 5% lower, with a low of $6.75 and a high of more than $7. The trade volume was significant, with 44 million shares traded, with the average volume being around 50 million shares. So with all this volatility, there are some concerns about potential manipulation, especially short selling. So it has been said that Lucid has been a target of short sellers with a short score of around 74 and a utilization rate of 83%. The total value of the short position in Lucid totals about $1.3 billion, which is a substantial amount. So recently, the short sellers also increased their positions by more than 5 million shares, representing about 22% of the free float. So the concerns about the manipulation and shorting have been, significant and looked upon by the company. The cost to borrow shares has occasionally dipped into the negative territory, indicating that brokers may be paying people to short the stock. The data points also suggest that naked shorting has occurred, leading to substantial short interest despite Lucid's production and delivery progress. So, to address those issues, Lucid has considered hiring a third party monitoring service like Share Intel. Those companies can help identify and address the instances of shorting, leading to a fairer market for the investors overall. It also provides additional transparency in trading activity and to make sure that there is a strict adherence to regulations that can boost the market's confidence and to protect the company's interests, and indirectly the shareholders' interest. Investors are now waiting for Lucid's Q2 earnings report, and there are a lot of expectations going everywhere. Analysts are kind of predicting an EPS of negative 34 cents based on about 8 estimates. And also, the revenue is now expected to reach around 185 million, which is the common prediction of around 7 analysts. Of course, let's be honest here, Lucid has been facing some ongoing challenges, such as the lower than expected vehicle deliveries. But with that being said, it still remains a relatively favorable company compared to many other EV startups. So the short interest in Lucid is significantly higher than many other EV manufacturers in a similar position. So this is why I would say that yes, they have a case here regarding tackling the shorting situation, and a short squeeze has the potential to occur. I wouldn't say that this is the end all be all regarding Lucid's stock play, but I will say that it might be a significant element to take into consideration. The stock's momentum indicator suggests that the retail investors are taking profit at the moment. The key support levels are around $8.85, and the next significant resistance is around $7.53. So, institutional investors have increased their positions in Lucid as well, as shown in the latest 13F filings. But some bigger players like BlackRock and Vanguard will probably disclose their holdings at a later date. So, right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and declined quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So, this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflations. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So, really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions instead of choosing ETFs. So, simply put, my opinion about Lucid is that the stock will be experiencing significant volatilities amid the concerns for manipulation and short selling. The company is now tackling those issues, and we have yet to see if there's any sort of results. Now, with solid growth potential, Lucid does present opportunities for both short term and long term investors. And I believe that Lucid is still in the buy territories, but it would be the best to wait after the Q2 results to make any sort of significant action in that sense. In the meantime, I would say that regarding tackling the shorts, of course, Lucid is in a much stronger position, and we're really comparing apples and oranges here. But it kind of reminds me of when Molen has decided to tackle its shorts. As a result, it did like trigger some sort of temporary boost in the stock price. So it shouldn't be surprising that with Lucid, things could go a little bit similar too. But again, the two companies are in different situations, so one doesn't equal the other.